Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, October 31, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on that docket today? Well, first thing is we had a pretty healthy down day, if you will. That trend line seems to be of the utmost importance. We had a gap lower open. The SPX finished down about 108 points, $11.37 in the SPY. That's a almost 2% down day. That's a pretty healthy day across the board. We'll get to the other markets later, but the Qs were down 2.5%. But yet the Dow was only down 0.8%. The transports were down less than that. So we'll take a look at that stuff a little bit later. The SPY traded right into the 50-period moving average where there's natural support. Why do I say natural support? We're in the vicinity of natural support. You see these lows here? At some point, the market went above that price and then came down and found support at those lows and decided to go up again. That makes those lows an important area that the market knows about. Remember, she gapped over that stuff before. We can trace it back even farther, and you can go back to here and say, look, the whole idea, the vicinity over here is she had trouble getting through this area, jumped it, tested it, went up, coming back to retest it. Whether or not it's the exact low, a couple of pennies above that, a couple of pennies below, is insignificant. What I'm discussing right now is the concept of the market went right to and stopped on the 50-period moving average, which is just above an important area. We'll find numbers for inside the number members and live room members in the morning. They'll have the SPY numbers, the Q numbers, the IWM numbers. Speaking of numbers, you're looking at an SPY and an IWM chart with the numbers that are on the board for inside the number members and inside the live room members each and every day. We have IWM numbers, we have Q numbers, we have a whole list of markets. You already know about that now. I've been talking about it for a while. The point that I want to make is, now look at these lines. This was today's pivot, 575.50. You'll notice the market couldn't get above the pivot. You'll notice every number that she broke below, she always came back to test the higher number. So broke below 574.10, went to 573.35, run a test of the higher number. Can't get through, failed, went down. Same routine. Got down to the 570.45, traded back up to the 572.05, and so on. Same thing in the IWM. Each number that's broken, she runs a back test of the prior number, and on a failure tells you something about the intraday activity of the market, obviously, but you have to have the numbers to begin with. Back to the daily chart. We have end of month. Today is end of month. So let's look at the monthly chart and see what we find. We already know that that trend line was important. We could take it off the board. We don't need it. What do we find on a monthly chart? We find a couple of things. We find a month that made a new high and finished pretty much at, maybe not at, but near the low. It's putting in what we call, or put in what we call a pseudo doji candle. That's something that's taught in the course, Lazy E-mini Trader. It's one of many, but one of our signs and or signals of a trend change. Next month, I'll remind you, is an on-time type of situation, the monthly chart. What do we see when we look at the weekly chart? Well, we see we're no longer in the air-quoted overbought condition above the 20-period or home base moving average, and she's already come back down to give up the last few weeks of market activity, and we're right back where we were at the end of September / the beginning of October. But wait, there's more. Today's low, which was pretty much the closing price, they closed pretty much on the low, is a stone's throw away from the most recent breakout area, which AKA is support. 565.16, we'll call it 565 for argument's sake, and therefore you can see what's going on there. We have this high here. We have another set of highs where the market couldn't break above until she did. That's just below 565. And you have a gap down here. That is 561.40. So between 565 and 561.40, give or take, is the next area of support where the market should get one of those proverbial bounce back in the other direction. Even if it's from an intraday type of situation, there's going to be support in that zone. Through the magic of math, I moved that number down to 560, and we'll call the zone 565 down to 560 and a half, round it to 560 if you want, as the next area of natural support, where from a minimum of an intraday perspective, you should get a bounce back away from that zone if reached sooner than later. Now, you could get the DCB on Friday. What's the DCB? The dead cat bounce. By the way, just as an aside, anybody remember that thumbnail from last night? This was on last night's video. The trend line gave way, and look what happened, by the by. So I would write this down on a sticky note, and I'll explain it this way. I'm not going to eat my hat or anything if the market doesn't bounce there, but you have these lows here where the market thought that price was pretty important. It's also the most recent breakout area and an unfilled gap. So this whole area is pretty important, I would say, at least from a short-term perspective. Might want to write that down, put it on a sticky note. Speaking of DCBs, which I brought up a moment ago, dead cat bounces, what's the likelihood of a dead cat bounce? Well, we never know, but when the market finishes on a low, meaning they kill them into the close. So if you look at the 5-minute chart, you can see what happened. A little bit of a fake out operation. Last 10 minutes of the session, they killed them into the close. Sent the market down about 35 S&P handles in 10 minutes. A lot of times, not every time, a lot of times when that happens, you'll get what's called a DCB or dead cat bounce leading into the next day. Now, whether or not that bounce holds is a whole different ballgame. But just saying something to look out for in the morning, one of those DCBs. Now, what if they're gapping it lower in the morning? You're looking for this zone, 565 down to 560.50. You can round it down to 560. There's another gap down here. If you want to keep going lower, you can always find stuff. The closing print is 559.09. That's an open gap just below 560. And then you have the 100 period moving average coming in right around 557 and a half. We can keep going all day. Inside the number members, we'll have the necessary numbers. What about inside the numbers? We'll check out and highlight a few important things today. And then what I'll urge you to do is pause the video, read the notes, go back to the chart to double check the work. Congratulations to the Dodger fans out there. The Yankees blew it, but the Dodgers deserve it. They played better. Any way you look at it, that's the way we started out the day. Then we had the 575.50 on the board early. That was the early pivot. Thieves in the morning already did it, spiked it, and bounced back. And you can see this includes the pre-market activity. So they're gapping down early in the pre-market, right? So here's your 4 o'clock print AM when the market actually opens, the pre-market opens, the Globex session for the spiders, whatever you want to call it, electronic session. And they find support down at 575.50 or 575, a little bit above that, and they bounce off of it. And then you could see what happened by the opening bell. That was absolutely resistance, and they never looked back and sold them all day long. Quite interesting how that was set up in the pre-market on the other side of the coin. But that was our early pivot nonetheless. So then we have what we call the morning scoop for the morning trade. We're looking for the morning trade. Well, today, the morning trade, the zone that I was targeting really didn't work. So what I was saying was the pivot, 575.50 down to 574.10, give or take, is a support and bounce back in the other direction zone. Now, it worked a little bit, and we did have some traders that got a base hit out of this, buying in the zone and taking some profit at the pivot. But by and large, my expectation was that this was going to be a support zone and they would bounce back up. What happened was once they got below 574.10, and you'll see this on the board, and this is where it becomes extremely important for traders to pay attention. Once they get below and stay below a number, it opens the door to the next number. So once they got below and stayed below 574.10, you can see here, back tested it one time, and then they started to fall away. And then when they get below the next number, which was short-term support, and we're going to see that in a moment. This was a setup in the pre-market, but again, we'll have, you see here, 573.35. That's if they're below 574.10. And you can see how that works from a short-term perspective, and they bounce back to what? 574.10. Now, that is a scalp trade, and we did have traders that made money there for sure. However, and our scalp trades are different than the 2-point traders, right? We're not looking for 2 or 3 points. We're looking for a minimum base hit to get into a trade is 5 to 7 S&P handles, 50 to 70 SPY cents. 5 to 7 S&P handles gives you $500 to $700 on 2 ES contracts. That's what we're doing. Once they got below the next number, it opens the door to the next number. And you'll see that in the notes as we scroll up. And what I urge you to do is pause the video, read the notes, go back to the chart, and double check the work. All the numbers were in there. They stopped at each number, but they didn't really give a stout rally away from each number. They just gave small bounces at the numbers. And what you did have by the end of the day, was basically a trend day down, which doesn't happen that often. And we talk about this in the live room. They do happen. They don't happen that often. They are an awareness. It's just not something we look for each and every day. 572.05 was another number that you saw in the commentary. It's another number on the board. And you can see here, stopped there, gave it up, rallied back toward that number even into the end of the day. The high was just a couple of pennies away. 572 even really is the same thing as 572.05. It's a rounding error, but it was overhead resistance once they get below. Regardless of whether trading was easy or difficult on any given day, the numbers were still on the board, and yet the numbers still did work regardless of whether they provided a whopper trade or not. You can see where the numbers certainly were important to say the least. Now, what's going on over in Camp IWM? Down 1.6%, $3.68. You can see this big candle down today, finishing below the 50-period moving average, where they did have a bounce off of it, first time, best time. Here they tried, and we talked about it yesterday, they tried to run a test in the vicinity of, the neighborhood of the breakdown candle high. They didn't quite get to the high. They got in the neighborhood, the ballpark. Came all the way back down. We're riding the 20-period moving average, and you can see the spiders gave up that trend line. We had to gap down today. And in fact, early on today, you could see this. The IWM really wasn't really down. Wasn't really down isn't really a sentence. However, you could see here, right of the vertical is today's activity. Early on, they were flat. They were up a touch. That was courtesy of the Trick, Trap, Fool, and Frustrate crew. Their job is to make as many traders and investors look like fools as much of the time as possible. Between the IWM and Team Transports, they wanted you to believe there was relative strength and things would turn around. Courtesy of the Trick, Trap, Fool, and Frustrate crew. The thing you have below here is a breakup candle low that they ran a test of already. Similar to this, they didn't quite get there. They didn't get to the breakdown candle high. Here, they didn't get to the break that up candle low. So I would say first time, best time, and I wouldn't trust that the next time around. That's an opinion, not necessarily a guarantee. I like the first time, best time type of concept. Ask the traders in the live room about that one. I love the first time, best time. I don't like adding variable risk. When you take a trade at the same place or general area, second or third or fourth time down or up, it's not the same as first time, therefore and hence first time, best time. No longer above all the moving averages, trend is your friend on the daily chart. Now, if they have a DCB and snap right back above the 50-period moving average, we'll give them their due and give them some time to work back over the 20. But if they give up the 50 and they confirm below her, meaning close a few days down below the 50, then the trend is no longer your friend, meaning no longer up on the daily chart. Now, the weekly chart, different situation. Are they coming down to run a test of the 20-week moving average and that's it? Well, we'll see, and we'll talk about that next week on the close of this week that doesn't close till Friday's close. What about the folks down at the transportation department? As you can see, they are above all the moving averages, and the trend is, in fact, still your friend. Couple of tail candles, does that mean anything? Not really. We'll take the trend as the dominant thing, and as long as they stay above, A, the 20-period moving average, and B, this breakup candle low and the 50-period moving average down here around 16,000, give or take, as long as they stay above there, there's technically nothing wrong with Team Transports. We will note, however, the pickup in volume today on the transports. We will note the pickup in volume in the SPY. We will note the pickup in volume in the SPX. A little bit of a pickup in volume in the IWM. Back to Team Transports. A pickup in volume simply means we had some additional institutional participation on the downside of the tape. It's of note, a puzzle piece, we put it on the table. It's not an end-all, be-all. It's information. It's a puzzle piece. From a weekly chart perspective on the transports, absolutely nothing wrong with this chart. It wasn't even a blip on the screen, on the radar screen, meaning today's down day. The weekly chart is firmly in an uptrend, period, full stop. Today's day, down day, but not catastrophic. What we will say is this could be the makings of a lower high. You have a high and you have a lower high. That is a possibility. And if they get below these moving averages and confirm that, that's a very negative sign, and they will have a leg lower. And just by getting down here, that's not going to be the end of the leg lower. That will be the confirmation of the leg lower. So we'll note that potential lower high scenario in Team Transports. Moving on to the Q people, down 12.5 bucks or 2.5%. Healthy down day. Could get a DCB. They're hovering over the 50-period moving average, and the 100's not that far below. You have these lows here, natural area of support, and you have a gap down here. Similar story to the spiders, just a different position on the chart. If I take these lows, that's a natural place on the chart, and you say, let me draw a line over, and you say, well, that comes right in the midst of where those moving averages are, and then you have another line down at this gap down here, and you say, all right, so I could see where 480 down to 472 is a natural area of support. Not an intraday trade, similar to what I said before in the spiders. That zone of 4 or 4.5 bucks, whatever it was, is not an intraday trading zone per se. It's an area that you should find at minimum of intraday support. There's a difference there. And remember, inside the number members will have the necessary numbers. We're going over the video at night, going over the big picture. How you doing? What about the financials? So the financials in one swoop gave up the 20-period moving average unless we get the reflex rally / DCB. They're headed toward the 45.90 area and the 50-period moving average. It's an important place where we should get a bounce back in the other direction. You can see also this was accompanied by institutional participation, also known as an uptick in volume. Weekly chart rolling over or eating time off the clock, beginning to eat time off the clock to make another push higher. We don't know yet. We're the umpire calling balls and strikes. How about the SMH or smash mouth? How about down 9 bucks or 3.5%? How about that $14 down day? How about that bearish, flaggish, wedgish, sloppyish pattern? How about giving up the moving averages? How about in one fell swoop, rolling over and giving up potentially. We'll see where the week closes tomorrow, but potentially giving up the 20-week moving average. We have a high and we have a potential lower high, or for now, we do have a lower high. We've been talking about this as our canary in the coal mine on this potential turning point. Are we looking for a turning point? Are we looking for more volatility in and around the election? Is this going to be just straight up into and then past the election? And I kept saying, I don't think so. We talked about it in the live room. We talked about it in these videos here. Expect more volatility. Guess what? The VIX is at $23. I've been saying expect more volatility. I've been looking at this as a bullish pattern. We talked about it a couple of times already. Look above all the moving averages. This is breaking up. The market is always telling a tale. It's always telling a story. Can you read the story? Is the story printed in your language, or a language you can read? The charts are a language. If they're going to continue and we don't get a reflex snack back, you have a gap down here, you have a 200 period moving average. There's a lot of stuff below current price over in the Philadelphia semiconductor space. One more thing. Remember last night we went over GDX and I talked about the relationship between GDX and gold. Not that there is an interrelationship directly, but there's a relationship in terms of a lot of times the move in the miners will occur before the move in the metal. Why does it happen? The miners are moving because it's projecting that the future price of the metal is going in a certain direction, and therefore the miners are in fact tied to the price of the metal. If I have rights or own a mine and it costs me X to mine the gold, and the price of gold is Y, and the price of gold either goes up or down, well, that affects the value of what that mine is to me and my company, right? Yeah, of course. So how about a $50 down day today in gold? It was eventually going to happen. I'm not saying that was a top in gold. I'm not saying it's going to collapse or anything like that. All I'm saying is stuff goes up, then it pulls back. Stuff goes up and it pulls back. Stuff goes up and it pulls back. It goes sideways. There are corrections along the way. That's the way things work. However, you look at the weekly chart and this closes tomorrow. Is this putting in a tail, and do they need to come back toward, not necessarily all the way to, but toward the 20-period moving average on the weekly chart in the metal of gold? Maybe. We'll see how that works out. But everything goes up, then it pulls back. It goes down, it bounces back up. The markets ebb and flow. That's naturally the way markets work. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.